Here we are looking at the financial statements or the annual report for McDonald's Corporation. I've already skipped over the first part of it and went right to the financial statements. First one they have listed is for McDonald's is the statement of income or income statement. I just want to spend a few minutes looking at these statements and just pointing out how much we've already been able to learn from financial statements and from what we've discussed in the textbook. So looking again at this is 3 years side by side. You can see some interesting things have happened just in the revenue section up at the top. 3 types of revenue for McDonald's. So we have the sales by restaurants that are company operated. That means that McDonald's themselves own these restaurants, and this is all of the sales of food in those restaurants. Okay, so that's for 2022, that's 8.7 billion. Again, rounded in millions, rounded off, left off 6 zeros in this case, as we've found in the past. Okay, for 2022. Notice that that is significantly lower than 2021. So when we think about greater recovery from the pandemic and such, they actually, for sales from these company-owned operated restaurants, it went down. So most likely that means that some of the McDonald's stores have been, or restaurants have been closed around the world. My guess, and we could dig into the footnotes and such to find some explanation, is probably the closing of restaurants in Russia is probably at least part of that company-owned restaurants drop in sales. Now, the next revenue is from franchise restaurants. This is where McDonald's does not own the restaurant itself. Instead, they have sold a franchise to someone else, to a entrepreneur who is actually selling the food. They pay McDonald's a percentage of their sales. You see that percentage, which is probably less than 10%, is $14 billion. So if you imagine how many more franchise restaurants they have versus company-owned restaurants, it's a lot higher number. Okay, and that's what's indicated. So we already are starting to see that there is some differences in how they operate and how most of the stores are franchised. And we can see the trend is different for revenues from franchise restaurants, those that are being operated by franchisors. The revenue that goes to a McDonald's is going up and significantly higher than in 2020. Okay, other revenues probably, we see a drop off, but that's not a big number, and so we're not as concerned about that. Total revenues is still slightly lower in 2022 than it was in 2021. Okay, so then we go to the expenses. We see that the major expenses, food and paper, is also down. Okay. So the revenues are down a little bit. So are the food and paper. That's to be expected. Payroll is slightly down. Occupancy costs, that's rent and all those types of things, is also down. So they're all following the same trend, these expenses, as the revenues. So even though revenue's down, we were able to cut expenses. And so if you look down under operating income, okay, while it's down, it's not as bad as we might think given the sales, flat sales there. Okay, depreciation is the same. We'll learn about that expense a little bit more later classes. Other expenses up a little bit. That's not a good sign. Some of those, and then the other expense, notice that in 2021, it was an income. See how they have that in parentheses. If it's an income, parentheses indicates that it's not as expected, meaning we expect expenses to be subtracted. In 2021, that was actually added. That was an other income, probably some gains from the sale of some things that didn't happen in 2022. And that is a big reason why our total operating costs went up by $1 billion between 21 and 22. So we're starting to see some of the story there. Other doesn't concern us as much as our food and paper costs and payroll, those sorts of things. Those we're more concerned about having under control and that they are actually happening the way we would expect. Okay, we have some interest, other expense, and then we have provision for income taxes, like we mentioned earlier, with we're paying, having taxes of about $1.6 billion on income of just under $8 billion for the year. So net income dropped, but it's still higher than 2020 on a per share basis. That's about $8 per share. And while dividends are not an expense and not belong on the income statement, they do put this information about how much the dividends were declared during 2022. You can see that the board of directors chose to share $5 per, almost $6 of the income that the company made. So the company made $8 per share, okay, split amongst all of the shareholders, and paid out $5. Okay, so most of the money that McDonald's made in 2022, they're actually giving back to the shareholders, who are the owners, that's who it belongs to, rather than keeping it in retained earnings and allowing McDonald's to grow and buy new stores, things like that. Now skip over the statement of comprehensive income. As we talked about, that's the one we're not going to focus on this term. And going to the balance sheet. All right, now in our typical situation, we would typically go to the statement of changes in equity next. Okay, that's the order we should prepare them. We should always start with the income statement, then the statement of equity, then the balance sheet. Okay, so we're doing this a little bit out of order, but we're just going to take a peek at the balance sheet. You see 2 years of balance sheet numbers. Remember, the balance sheet is given as of a certain date. It doesn't say year ended. It says as of December 31st. They have a lot of assets. McDonald's has a lot of assets. You can see some of the bigger assets they have. They have $2.5 billion of cash. Okay, a lot of money that's owed to them by customers. All those people, that's not really customers. It's more their franchisees. Franchisees have 30 days to pay their fees to McDonald's for their sales. So they, at any given time, they owe a lot of money. This looks like about $2 billion, some prepaid. Those are expenses that were paid that are going to be used later. Some goodwill. We'll talk a little bit more about goodwill in Accounting 151, but goodwill is when they bought other companies and paid more than the cost of the assets. But their biggest assets are property and equipment and leased right of use assets. Those are stores that they have leased and control, but don't technically own. Okay. Property and equipment are those that they actually own. And of course, McDonald's owns a whole bunch of production that they use to produce the stuff that is sold to the franchisor stores, who then cook it and give it to you. But you have to buy from McDonald's. And so they have a lot of production material. You make the frozen fries, you make the patties, all those kind of things. And that all requires equipment and machinery. A lot of liabilities is what we owe. Accounts payables, where they owe for things that they bought on credit. They're going to pay later. Accrued payroll is employees that have worked but we haven't paid them yet. Income taxes that we have calculated we owe and haven't paid the government yet. All of those types of things that we owe. And then look at this large long-term debt, $36 billion in long-term debt, another $12 billion in lease liabilities on those stores that they lease for a long time, and they owe payments on those for a long period of time. We talked about capital stock. They use a little different terminology here. Common stock and additional paid-in capital together would be your capital stock, what we've talked about. You can see this is the total amount that the shareholders have contributed to for their stock over the years to McDonald's. Is a little bit over $8.5 billion. And then you have the retained earnings, which is the total amount that McDonald's has earned but has not paid out as dividends since the beginning of the McDonald's, and that's about $59 billion. And we'll ignore some of those last numbers there as something that we'll do in later classes. I want to skip over cash flow, go to the stockholders' equity. Remember that we're mostly concerned about the capital stock column and the retained earnings column. And I'm just focusing on the retained earnings column for 2022. They had $57 billion in retained earnings at the end of 2021. During 2022, they made net income of $6.2 billion. That's from the income statement, right? And they paid out, as we talked about, $4 billion, or 2/3 of it, if you will, in dividends. So they made $6 billion, they paid out $4 billion. So roughly they had $2 billion that they retained. And so you see that retained earnings went up from 57 to 59 billion, or 57.5 to 59.5 billion during 2022. So we're already getting part of the story, what the picture is of the company here. And then let's peek at the cash flow. Okay, cash flow. Remember, there's 3 sections: operating, the day-to-day activities. They had $7.3 billion that came in from customers, from the sales. That's about $2 billion less than last year. We already noted that there was some drop off in some things in 2021 to 2022. But in investing, they actually spent more. Remember, investing is buying and selling long-term assets. The negative is when they're buying long-term assets. Capital expenditures is new equipment, new buildings, that sort of thing. New restaurant businesses, they pick up locations and things like that they're going to use. And then when they sell some, they get some cash, and that's the 445. Okay, so when they paid a lot more for the new ones than they sold the old ones for. And that's typical. It means they're growing, they're getting more stores, and that's what that makes up the investing. So we have the new restaurants, but we also have new equipment that goes in the restaurants, new equipment that goes into their production facilities, and then under finance, we're talking about borrowing money, right? First of all, the dividends are always under financing, okay? And so for their loans, they got 3.3, they borrowed more, and they paid off 2.2. So they're constantly borrowing more money, paying it off, getting new loans to pay off old loans from various banks, that sort of thing. And you can see that change. And the difference is they end up with more loans, and they owe more money at the end of the year than they did at the beginning of the year. Okay. Financing was total of negative $6.5 billion paid out. Okay. Most of that is the common stock dividends. And so their cash actually decreased by $2 billion from the beginning to the end of the year. But don't worry, they had $4.7 billion at the beginning, and they've got $2.5. Still a significant amount of cash and cash equivalents. However, if they were going to decrease their cash by that same amount, now we're starting to talk, getting a little close, right? To if they decreased it by $2 billion next year. Okay, that would maybe start to set off some alarm bells because they would be getting close to not having enough for their operations. They have lots of access to borrowing and things to make up for any shortfall during the year, though. So that's all the kinds of things in the story we're able to tell already looking at these financial statements, given what we've discussed in chapter 3 and previous chapters, we should have a pretty good understanding of the different definitions, what an assets, liabilities, equity, okay, what revenues and expenses, how the cash flow works, all of those things as we try to understand what McDonald's or whatever company we're looking at is communicating in their picture of their financial situation.